Hello and welcome to myfinanceteacher.org. Q3 quarterly reports from some of the miners came out already, and I want to have a look at an updated view of Newmont and Barrick today. So as usual, our valuation factors are gold price, the reserves and resources in the ground, the debts that the companies carry, taxes, number of shares outstanding, we do take into account discounting, and the number of shares in the insider hands, as we generally look at the discounted per share value after all-in sustaining costs, long-term debts, and taxes. As usual, we're going to look at three scenarios for gold price, with a balanced scenario averaging somewhere around $1,800 over the next couple of years, with a conservative scenario averaging somewhere around $1,600 over the next couple of years, and with the optimistic scenario averaging somewhere around $2,000 over the next couple of years. Notice that our optimistic scenario is not outlandishly optimistic. I think there is a pretty good chance that gold price over the next couple of years might actually reach far beyond $2,000. But while talking about gold price, there is a bit of a correction to make for a couple of the previous videos for Q2 reports on Newmont and Barrick over here from middle of November, as well as on Agnico Eagle and AngloGold Ashanti from the second half of November. While I mentioned that the scenarios included the same gold prices of $1,600, $1,800, and $2,000, there was a bit of a mistake. Actual valuations were for the prices of $1,500, $1,700, and $1,900. Instead, plugging in these gold prices at $1,600, $1,800, and $2,000 will improve valuations significantly. We'll have a look at the new results in a minute. With a quick review, both Newmont and Barrick have significant gold as well as silver reserves and resources. Remember, we only look at proven and probable reserves as well as measured and indicated resources for gold, silver, and copper. Beyond all of these numbers, both of these have substantial inferred resources, but as those are a little bit less certain, we don't even include those in the valuations, making our valuations that much more conservative. And if you compare these numbers for reserves with what the companies report right now, you'll find that my numbers are slightly smaller because I already reduced those reserves by how much has been produced since the last reporting of these reserves at the end of 2021. So moving on to all-in sustaining costs, compared to Q2 results, there isn't much difference there, with $1,080 in all-in sustaining costs for Barrick and slightly higher at $1,130 per gold equivalent ounce in case of Newmont. Long-term debts have decreased for both of the companies a little bit, down to $6.03 billion for Newmont and $5.08 billion for Newmont. For taxes, for simplicity, I just assume 20% tax for all of the miners that I look at. Again, compared to recent Q2 reports, there aren't many changes in the numbers of shares outstanding or the percentage in insider hands, at 794 million shares for Newmont and 0.17% in insider hands, and 1.67 billion shares outstanding for Barrick and 0.6% in insider hands. Same for a reserve life, not much change here over the last several months. Reserves last for 13 and 15 years respectively for these two, and throwing in additional half of the M&I resources increases the reserves and resources life to 18 years and 27 years for these two respectively. And for discounting, I'm going to use a discount rate of 5%. A caveat here, a point to remember here, is having enough liquidity. That's an important factor for all miners, even some of the largest miners in the world. As we remember a few years ago, Goldcorp, which used to be the largest gold miner in the world, basically faced a bit of a liquidity crunch and was eventually acquired by Newmont. So in addition to calculating the actual value per share that the companies hold in the ground, you also might want to have a quick peek at liquidity, which we do with the members at myfinanceteacher.org. Check us out, as this introductory half-price offer for the first month is going to be removed at the beginning of January. So coming back to these two largest miners, and finally looking at the valuation, starting with the conservative valuation, where again we only plug in the gold price of $1,600 and we only look at the value of the proven and probable reserves in the ground, without even adding measured and indicated resources, never mind inferred resources. That gives a conservative valuation of above $38 for Newmont and slightly over $13 for Barrick. So what this valuation tells you is where you might expect the level of risk is for these miners if, let's say, gold price just drops out of bed and stays somewhere around $600 over the next couple of years. Looking at balanced valuation, again, we plug in the gold price of $1,800 and we still only look at the proven and probable reserves in the ground without any M&I or inferred resources, even in the balanced valuation, which gives us $56 for Newmont and around $18.6 for Barrick. It's pretty close to where share prices are right now, which is encouraging, confirming that the calibration of this valuation model is pretty good at the moment. Gold price is slightly below 1800, with the share prices on the miners slightly below this valuation. And lastly, moving on to the optimistic valuation, where we plug in the gold price of just $2,000, not outlandishly optimistic, and we only look at the value of proven and probable reserves and only half of measured and indicated resources, never mind any of the inferred resources or any additional exploration potential. That gives us an optimistic value of over $97 for Newmont and over $33 for Barrick. Pretty good potential if you ask me, but instead I want to ask you, what would you have for your optimistic scenario for gold price over the next couple of years? Let me know down in the comments below. Have a nice day. Bye-bye.